Hello and welcome back to Radio Rothbard. I'm Ryan McMakin. I'm a senior editor with the Mises Institute, and with me, as always, is my co-host, Tho Bishop. And also with us today is senior fellow Mark Thornton from the Mises Institute. And Mark has all sorts of writings on the business cycle, and has written for years on the economy. And one of his most recent books is on the skyscraper curse, which provides just in general a great primer on business cycles and how inflation feeds into those and what are the results of inflation and bubbles and all of that. And so I have Mark on today because I want to talk a little bit about where are we in the business cycle, and is there a recession now? Is that even the right question to ask? But we know what the main narrative is it's the job market is great. Inflation isn't that bad. That we'll have a soft landing. I know that if you just keep up with financial Twitter, you still got guys out there talking about, oh, at worst, it's going to be a mild recession, all this sort of stuff that we're hearing about. And there doesn't seem to be any real understanding of how business cycles work or the effects of inflation and all of that. So I want to have Mark come on and talk a little bit about that today. So Mark, let's just go ahead and get right into it. I mean, when we're looking at, is there a recession? Is that even the best question to ask? Maybe it is. And what should we be looking at? Because I know that the Fed always just says, hey, look at the jobs data and everything's great. So we'll just tweak a little bit and then we'll kill inflation and then everything will be fine. I mean, what really should we be thinking about when these guys at the Fed are trying to tell us what they're looking at?
Well, I think you need some perspective. And I always start out by looking at, why do we have prices that we have right now? Why is there an equilibrium? Why is there, half the people on one side of the market buying and the other half selling? And then I look backwards, and I look back to the recent bubbles, the tech bubble, the housing bubble. And finally, I think it's very important to look back at 2020 because we were anticipating the boom phase to turn to a bust phase in 2020 before COVID ever was a word, more or less a reality. And then in 2020, we got weapons of massive monetary destruction thrown into the economy. So things are not normal. And any kind of normal analysis or everything's okay, everything's normal conclusion should be tossed out immediately in favor of a little reality. And the reality is that we had a bubble in everything in 2021. Stocks, bonds, land, crypto, everything was up. Everything was doing extremely well. Real estate, the list goes on. And now we're in a significant turnaround of all that. And the idea that we're at a bottom or we're in the trough of the economy and everything is looking better and brighter and everything is looking up at this point in time seems to be just hope rather than reality of what we've experienced in the U.S. and world economy, for that matter. We've got to consider Europe and Asia and China in the picture because they all really do matter. And so when I look at all of that, I tend to view this current situation as a lull in the storm rather than the beginning of a new boom.
I mean, that's something that needs to be mentioned too, right? Is when you look back at 2019 and early 2020, it's almost as if COVID saved the narrative for the Fed, right? Because you were about to enter a recession at that time, or at least a significant slowdown, right? You looked at the repo mess that was going on in late 2019 and how the Fed had to restart quantitative easing, and they were already primed for a crisis, it seemed. And then COVID hit, and then we can just blame everything on COVID. And then we can blame everything on Putin. And so it was just really quite convenient then for for the Fed and the regime in general of, hey, look, everything would have been fine if not for COVID. And so I guess that just added another 2 years then to ignoring the everything bubble that was already gearing up in 2020. And then, as you said, it just went bonkers, like out of control.
And that's very, very important because it's hard to restart a bubble the way they did in 2020. But they did it, and they did it with trillions of dollars of spending and trillions of dollars of money and credit going into the economy. In 2019, they were already having minor emergencies, changes in policy. They were already showing signs of concern, despite the fact that all the aggregate numbers in the economy were just absolutely record-breaking. And so, they were very worried. I'm sure they were passing out diapers at the Board of Governors meetings. And COVID came in just at the right time and gave them the tremendous excuse, save the world type excuse that we had to unleash these weapons of monetary destruction. And they did.
How do we interpret it now, right? So one question, which we've already forgotten about, was a controversy from last year, was when you had 2 quarters in a row in the official data of the declining GDP, right, year over year. And so a lot of people look back and they saw, well, I mean, when you have that happen, it's usually declared a recession. But then the administration, it's not really a recession now. That doesn't mean, and they were technically correct, right? That's not like the final word in whether you're in a recession or not. But there was lots of debate over that. And I could see how they would make the point. When you're looking at some of the other factors, it didn't really seem to fit the description of a full-blown recession. But that doesn't mean that everything was just fine, right? As you were noting, right? Things weren't normal. We couldn't talk about things being normal. So when we're in this situation where everything's inflated and there's high inflation, what should we expect to happen, right? I think only the Austrians really provide kind of a view of what's the step-by-step process here. And if you don't have any grounding in that, it's real hard to guess. What should we even guess might happen next? So here we are. Yeah, you had a couple weak quarters of growth, but there was still a lot of wage growth, and prices are still up, which doesn't really say recession, right? But so really, what should we expect? What are really going to be the warning signs then for when we know that we're really going to be in trouble?
Well, I mean, maybe we should be less or more obvious on Mises Wire articles because we've been writing about this. I've written about the housing bubble that's now coming apart, and all of the individual statistics are turning negative. I wrote about the problems in tech and streaming a year ago about, how this bubble was blown out of proportion and partly just a COVID bubble, but a Fed bubble as well, and that we would expect to see lots of consolidation and layoffs and that sort of thing. And those layoffs that started in streaming have now migrated to tech, to Amazon, and to all support companies, staffing companies. So you're looking at not just layoffs, because those happen even in a normal economy all the time without the Fed. And but it's the type of layoffs that we're seeing that tell us that it's tech-oriented, it's investment in new technology-oriented type layoffs. And so when those things turn negative, watch out.
And in fact, I don't think there's been a public economist out there that probably has a better batting record than you, Mark, in terms of nailing these things. And one of my favorite articles of you in the last relatively recent history is on the Fed's real mandate, which, spoiler alert, isn't employment, it's not price stability, but it's serving the political elites. And that's one of the interesting dynamics that Ryan and I have talked a lot about, is that, as we see these warning signs go on, that the pain is not felt evenly across the board. So you have different groups worrying for different reasons. I mean, I feel like every week Elon Musk has a tweet complaining about rising interest rates. And so it's going to be interesting to see, particularly, I mean, you mentioned big tech and the layoffs there. I mean, you have certain industries that really can't remember what a raising interest rate is like. Never would have, again, nobody would have expected where we are right now with the federal funds rate, 2020. Which industries do you think are going to be the most impacted going forward? And is there perhaps some that might be able to weather the storm better than others?
Well, certainly. And the types of companies and industries that are going to be hurt going forward is going to be continuing in tech. And that sort of industry which benefits the most from the bubble, those will be the ones that are hurt most in the bust. We're going to see this migrate into finance, which has been pretty quiet lately, but we did hear lots of talk the last couple of weeks about the lack of bonuses for bankers and that sort of thing. So that's the first step. And then the second step is you're going to start to see layoffs and general cutbacks on the part of finance-related type companies, and then real estate, construction, all of those companies that are on the leading edge upwards in the boom phase of the business cycle are going to be the ones where you're going to see the most pain and the most negative reports moving forward. So that's where we're going to see most of the pain. And then, of course, there's industries that are better protected in our understanding of the business cycle, which are services, which are experiencing continued job growth and higher wages right now. That won't continue, but the absolute pain from layoffs will be less in consumer product and service related industries, the things that we need and use every day, whether or not we have a job. So if you want to get heavily invested in toothpaste, that would be great. But unfortunately, the toothpaste stocks are already pretty high.
Well, right. Even in the stock prices, of course, may not reflect the actual demand for the goods themselves, right? That may just reflect what they think they can sell the stock for later. And that's something that we've talked about on the side, is the lack of fundamentals that actually go into these prices, right? So real estate isn't being priced based on how you can cash flow with it. It's being priced based on how much you think it will appreciate because of new money coming into the economy, or because interest rates might go down. And these just aren't sorts of things that occur in a normal economy. This is just bubble type thinking.
Yes.
And so, as you say, it's just not normal.
Yes, and I think the number of assets that you can own that are not expected to go down further, that's a shrinking pool, right? Government bonds have gone down, the U.S. dollar's gone down, stocks have gone down, bonds have gone down, munis, corporates, land prices are falling, real estate prices are falling. So the areas which you can reasonably expect a positive return rather than a negative return, that universe is shrinking very fast right now. And so the closer end of the business cycle in consumer stocks, consumer goods, services, and maybe commodities have the less negative outlook in terms of their future prices.
Well, as you can imagine then, from all those things you just said, Wall Street would love to see a return to lower interest rates, to the good old days of easy money when everyone felt really intelligent and smart and like a great investor, because the prices of their assets just kept going up. Well, and so I'm seeing then Wall Street bankers, investment bank types, they're just straight up saying on Twitter, Dear Fed, please stop. You're killing us. You're letting rates go up too much. You're going to over tighten. And so a lot of this debate now is how long should the Fed raise rates? Now, I don't like to say raise rates as if the Fed can just set this, but how long is the Fed going to suppress rates less than they have been? Maybe is another way of putting it. And so how long are they going to do that? Will the political situation force them to push down rates again? And then, importantly, how long, from a more sound economic view, how long should the Fed really keep quantitative tightening going, right? Should the Fed really be focusing on emptying its portfolio? Should the Fed really take a longer-term view of keeping rates or letting rates rise significantly? Or is this just a temporary thing and we can just as soon as inflation goes down a few points, we can just go back to ultra low rates again and get back to the boom that we all enjoy?
Well, you're certainly right about, analysts coming on CNBC and Bloomberg. They're kind of like praying to the Fed, please stop raising rates because you're hurting my bonus prospects and so forth. But the hawkish stance of the Fed, which seems very unified right now, is all belied by the fact of what they did in 2020. That was not even really emergency measures. That was just insanity of monetary policy back then. But they really don't have any credibility, true credibility as being inflation hawks and that going forward. So I don't think it's going to be the case that the Fed really sticks to their guns. I think they're really sticking to their guns until they politically can't do anything else but try to reignite the boom. So, they are surely going to bend and, if not break, moving forward as, news in the economy turns more and more negative in the stock market. Because right now, the stock market has not, it's fallen noticeably, but I think, if you look at valuations in any historical fashion, you'll see that the prices of the stock indexes are still very high. But that means they have a long ways to go. And employment looks really good right now. But we see, good high-paying jobs being laid off all over the place. So I do expect them to pivot, the word is, on these shows. Pivot in the sense that they're going to move from this hawkish standpoint into a more dovish, inflationist standpoint as the news starts to turn decidedly negative in 2023. And so, there's a lot of things up in the air about the debt ceiling and about the reset business. All of that's going to come into play, but we can easily expect the Fed to stop its interest rate raising agenda, the idea that they're going to sell off their portfolio. Personally, I would like them to continue raising rates until they got to the point where they could just simply let rates in the federal funds market float and the banks be dependent upon their own money to meet their own reserve requirements, and then move forward from there in terms of reducing their portfolio. And I don't know what you would nowadays call normalized Federal Reserve policy. But we have a long ways to go, and they're still in this situation where they're exuding a hawkish stance. But I expect that to change in the other direction during this year, in 2023 for sure.
Well, and that's kind of the terrifying aspect of this is the degree to which psychologically, there's a lot of decision makers in very powerful institutions that their concept of what a bottom looks like might be much higher than than the reality there. Right? If you're ideologically cannot fully, if you think that things have more or less been going hunky dory, particularly since the response to the 2008 financial crisis, and that ultimately this is a problem that was created, in 2020, rather than something that's continued on as a result of decades now of this sort of policy, then your entire framework, your entire conception of just how bad things can be, and as those perceptions start to change over time, that can even further fuel a panic downwards. And it seems, I think one of the interesting dynamics out there is simply the I think perhaps an advantage that America has relative to the rest of the world, where there seems to be a little bit more aggressiveness from the Fed than you've seen at the ECB. You've seen at some of these foreign banks. If we're looking at skyscrapers, for example, like you can even see the fueling of the bubble, where a lot of the largest skyscrapers in the modern era have not been in the U.S. There's been a few in New York that are up there, but you see several in China, several in Asia, several in the Middle East. And so the international component of this gross expansionary monetary environment, this is not simply an American problem, a Fed problem. This is a global problem, and it will be interesting to see how these different banks compete amongst themselves in the next couple of years.
You're absolutely right about the psychological point, and I think that for Americans in the U.S. market, the pain has not been significant enough to date to get that panic-type reaction where people rethink the investment and the economic climate moving forward. I think more pain is going to have to come into and be revealed in the American economy in terms of jobs, in terms of interest rates, in terms of inflation, commodity prices, and so on, and that the panic situation that hasn't taken place here and now is likely to happen. If this is just a lull in the storm, then when increased pain comes into markets and people have to reevaluate their position in markets, I think that's really when the psychological changes start to take place and people panic and so forth. And I think that's happened in other countries. The European economy, I think, is psychologically as well as militarily and economically damaged, certainly by the European Central Bank. But as a worldwide phenomenon, there's still a lot of optimism in Asian economies with China reopening and so forth. In the commodity economies, the BRIC economies, there's still hope. But the U.S. is the biggest player in the game, and we have not reached that panic stage.
Yeah, something that keeps occurring to me once we get to the point here where as the economy progresses, and if we get to a point where you start to see the mainstream media finally admit, okay, there's a big problem in the economy, and even with the job situation looking bad. And so then if the narrative just turns toward the economy's bad, why is it bad? We're always in danger of learning the wrong lessons here, and this is where the Mises Institute has a thankless job, where we're always trying to note that the problem of the current bust began years ago, right? And perhaps you could say its roots are in 2008, 2009, but even it goes back further than that, right? Back to the Greenspan put and all of that stuff, right? And most people have forgotten about that. That just seems like ancient history. And but we still have to keep hitting on it, right? That you look back, and just a few years ago, you had Trump running trillion-dollar deficits, or nearly trillion-dollar deficits, $900 billion deficits, in a quote-unquote expansion in peacetime, where just spend, huge amounts of deficit spending, which of course helps drive then the need for new money. And so what you end up, though, with anyway is even the people who don't like Biden, they act like if the current economic woes are just Biden's fault, and that if we could just somehow go back to the policies of 2019 when things seemed good, then everything would be fixed and everything would be fine. Look how the economy grew under Trump before COVID. And so therefore, those policies must have been fine, right? And so the only lesson learned then is that Democrats cause recessions, if you take that side of things, right? And that yet again, the central bank evades blame. Somehow it's just the problem of Democrats raising taxes or something like that. And so then we've learned nothing through yet another cycle of boom and bust. And so what do you think is important to emphasize then when we're talking about how really it's these booms that really sow the seeds for the later bust, and that it's not really, oh, the Fed over-tightened, oh, the Democrats raised taxes too much, that it's the problem's much broader than that, and the central bank's at the center of it, or monetary expansion's at the center of it. I mean, what's the number one thing we really should focus on when trying to really expose what the true causes of the bust are, and it's not just some sort of short-term partisan thing?
Well, that's a great point, and that's why at the very beginning of this interview, I said, after we look at the equilibrium prices today, we look backward in history to, the institutional framework, which is boom bust, Fed-led bubbles, and busts and economic crises. That's the type of thing you have to think of when you sit down and look at individual statistics and individual stories, and so we've had, stories about negative interest rates, negative oil prices, shortages of baby food, all sorts of chaos that gets sloughed off as one-off stories in the economy. We had last year, we had the dollar escalate in value to over, I think it was 113 something versus other currencies. And, the commentator said, wow, this is just, demonstration of the strength of the U.S. economy, when it was really the weakness of all the other currencies in the world. And we were like the last solid currency standing. And, that story, like all those others, gets sloughed off when they're actually very meaningful about the economy. And today, the U.S. dollar, it sits at about at 100. So it's lost a lot of value in 3 months. And nobody's talking about it, but it's a huge change. The dollar has lost 10% of its value in 3 months. And so all those little stories seem to get pushed off to the side, and in front and center is, the Fed needs to protect us, the Fed needs to stimulate us, the Fed needs to do all these crazy things that in reality we can all do perfectly well on our own without the Fed messing things up. So we have to realize that in a longer term picture, we're in this boom-bust type of an economy led by the most powerful central bank that has ever existed, and it has cooperating partners around the world, and they're, destroying lives in the process, and the media that most people listen to simply slough that off as unimportant or not a real story, when in fact all of those little stories are part of the bigger picture of the destabilizing nature of central banking.
All right, well, we'll go ahead and let that be the last word on this episode of Radio Rothbard. Thank you, Tho Bishop, my co-host. Thank you, Mark Thornton, Senior Fellow at the Mises Institute, for joining us today. And we'll be back next week with another episode. And so we'll see you next time.